Want to bring in, though, some discussion on what's going on Wall Street for you. Al Fullerton's my guest host all this hour, senior broker at Aliom Financial Markets. Al, great to have you with us once again.
Lovely to be back.
Yeah, it's kind of one of those, I guess, tentative plays at the moment. We've seen good gains in the last few sessions on the street. Now, though, what's kind of exercising minds there?
Look, I think year-end rapidly increasing. I think that we certainly have seen some profit taking on the Santa Claus rally. I think we've certainly seen that in the gold space. We've seen some US dollar strength. We've seen some oil weakness, risk on. Are we going to see some window dressing before year end? Are we going to see some profit taking before year end? So it really is that time that as you get towards the Christmas break when you start seeing instos, PM start taking holidays, things start winding down. So it really is, it is that time when decisions have to be made to get squared for 2010.
You had that sagging greenback as a very good catalyst for buying.
Yes.
That trend's been reversed. So this talk of a Santa Claus rally, are you entirely won over by it as that dollar only goes higher?
Oh, look, I think that you're seeing a move back into equities there. I think you are seeing a bit more risk on the table there. You have seen, obviously, the Obama tax cuts certainly getting a bit more excitement into the markets there. They're starting to look not on a reliance just on the monetary policy, but obviously on the fiscal policy as well over there. So, look, I think that gives that consumer-driven society a bit more of a confident boost there. I think a lot of people are quite happy to draw a line through 2010, and so human mentality and psyche there may see a bit more, a bit more optimism for 2011, and so that could actually continue to spur on a bit more of a rally as we get towards Christmas.
Are you buying the fact you'll get economic acceleration from these tax cuts, that the follow through, that they will stick? That unlike QE2, where hot money flew out of the United States, there'll actually be a real dent, say, in unemployment come 2011?
Oh, look, I think it's going to be a long term. I think 2011 dent unemployment's a bit bullish. I think that it is going to take a long time, but I certainly think that the extension of these tax cuts, time and time again we go back to this point that it's a consumer-driven society. 70% of GDP comes from consumption. It's all about confidence over there. What they do need is they need some good leadership, and they need some decisions being made. And I think that there's some fiscal measures to coincide with QE2 certainly can have some positives. Saying that,
yes,
and obviously playing devil's advocate here, it is extending the debt. Their balance sheet is not looking great. In Europe, we're seeing sovereigns actually trying to get their balance sheets in order. The US seems to just be spending it, and they'll also have the balance sheet at a later date.
It's the old debate, isn't it? Do you get growth through austerity right to the minute, or do you need further injections? Just though on the US, this has only been extended for 2 years, Al.
Yes.
So it's conveniently
timed. It has, yes.
Yes, to run out bang on another presidential election. Again, we're going to be having this debate, aren't we, in another 12, 18 months as they get into elections?
We will, yeah. Look, none of these things are purely black and white, and certainly does coincide with some political things in a few years' time, but look, I think certainly if we go back to the point being that what they need is confidence over there, and I think certainly it's going to be a long run for them, but this is another measure there to try and continue to generate that confidence and that growth over in the US.
We always, speaking of confidence and speaking of China, say, well, things happen there without warning. So when least expected, and that's why investors act as they do. They can flood the market with cash, and then they can run for the hills. Now, at the moment, lots of data out next week. It was slated for Monday. Now that's being brought forward to Saturday. The reason being, look, let's balance the calendar. Let's get this month on month, get it right. But do you buy that one, or will they actually raise rates ahead of the game? Oh,
look, it's very hard to crystal ball what the state will do over there. They are, as you said, renowned for some surprises. Look, it is quite well broke that they are at a tightening policy at the moment, and they could well actually, move rates over the weekend. So look, it has been well flagged. I go back to that point that what we are looking for in China is sustainability. And we've seen the RBA over here looking to increase rates as a preemptive strike. just so in China we're seeing the ongoing, they're finding it exceptionally hard to try and maintain that inflation over there, sustainability in China, so a tightening stance and perhaps increasing rates further, while the markets don't like it. From a long-term and longevity, a going concern point of view, it is a positive.
So interesting how New Zealand, again, just on that decision on rates, RBNZ Governor Alan Bollard saying low rates have got a less stimulatory effect than in the past. That's actually taken about 0.5 cent out of the Kiwi cross against the greenback. Let's, though, leave that one aside. Take you into the United States. Al coming in on this conversation as well with me. And Alan Valdez.
Right now.
Steve, Al Fullerton, the Aliom markets. A few of my clients have been questioning why these Chinese companies aren't actually looking at listing on the Shanghai, not looking to list on the Hang Seng or the Asian markets. Why they're having to go to the US markets? Why they're having to go to the Aussie markets to raise capital? Now, what are your thoughts on that?
Well, I know, speaking from experience, because I've been involved in a couple of these IPOs from Asia, they just like the American markets. They like that exposure. They like the fact that they are listed here in New York and on other NASDAQ and other American markets. I'm sure it's the same with the Aussie markets. They like that exposure down here to the dollar, to the Aussie dollar. They feel, I think, you get more people involved in it than Shanghai.
Al Fullerton's my guest host all this hour from Aliom Financial, and Al, just still on what's moving Wall Street at the moment. This dollar play, we've sort of talked about it, but you kind of got to ask yourself, what are going to be the influences from where you sit? Because yesterday in tax, and as we were just discussing, you're inevitably going to run that deficit for longer.
Yes.
Maybe even QE3 could still happen. I mean, that would only be worse for the greenback.
It would be.
Do you get a sense that that debate is shifting, that now, because of Obama's breakthrough, there's less need for the Fed?
Look, I think that it's going to certainly have to be a wait and see. I think we're really going to have to see. There's going to be a lagging effect, obviously, on what we're seeing at the moment is investors and consumers reacting to this on them seeing this as certainly as a short-term positive for additional liquidity and stimulus. But often there is a lag effect there, and as we said, there's going to be a hangover of debt. I really think what we have to focus on is the fact that is this going to, in a longevity point of view, is this going to be the sustainability of the US balance sheet? And we spoke about Europe before and with our guest before over in the US, mentioning that they're not happy with what the Europeans are doing in terms of the bailouts, and they're worried about Portugal and Spain and whatnot. But at the same time, let's focus on the US balance sheet. What's going on there? This can't continue forever. Obviously, tax cuts are tax cuts. They're obviously receiving less funds in there. It's going to be a very interesting, an interesting play.
Then again, offsetting that, you lower people's payroll taxes, you stimulate, arguably, the appetite for consumer spending, and I guess with that, commercial property maybe gets a rebound as much as residential.
There's going to be lots of positives that will come through there in terms of QE2. If there's a QE3, it's great. We saw it last Christmas when Kevin gave us all $1,000 to go and spend, and we went crazy, and retail sales went through the roof. And this year everyone's, where's our $1,000? And the retailers are banging the table. Look, it's not sustainable. It's a one-off. QE2, QE3. If we get that, look, it's going to be great. People will go out, they'll spend money, they'll party, they'll employ. It could actually work. It maybe hasn't historically in the past. But then the US, this isn't the past. Let's not look at so much historical data. We say, well, that's what we need in the US is confidence. We need liquidity. We need cash. We need people to go and spend. And you need a good leader. We need the Fed to sit there like a good general in the history and rally the troops and say, go out and spend money, go out and invest.
Also, can't you target your stimulus? We're not suggesting a scattergun approach. I mean, in the same way as you got the auto sector. That was very much bailed out when it was on the brink. Sure. You had your Chryslers, your Fords, your GMs, all going cap in hand, and it did seem to work. Then you also had, the likes of your financials. The City yesterday, we've talked about that one. So it's hardly a lesson in a futile confetti spray of cash.
No, true, but I think what we saw with perhaps the car market is that they grabbed them by the legs, gave them a shake, and they said, look, the old ways aren't working.
Yeah.
It's 2010. For the next decade, you have to look at different measures there. I think the banks, okay, look, these derivative structures weren't working. And what it has done, if anything, is it's actually pared away components of businesses that were not profitable, that were perhaps a bit old school, a bit archaic. Perhaps there were methods that weren't working. There were too high risks, ventures on the derivative space in terms of the financial sector. So what that did is really sort of we shook them out, it pared them back often to their core assets or their core business model. And we have certainly seen in recent reporting seasons